Today's snack is a bite-sized lesson because of COVID-19, or better yet, known as the coronavirus. Welcome to Snack on This, the coronavirus market. For anyone with some sort of access to technology, you may have noticed declines in the stock markets across the globe, from Japan to China, from London to South Africa, from South America to the good old US of A. World markets have shown huge drop in stock price, primarily reacting to the fear and uncertainty of the coronavirus. Now, as a disclaimer, before we begin, we are here to strictly inform you. We are not licensed professionals to be able to advise you to take any sort of action directly as a result of our recommendations, but we're here to more provide you the education and the bite-sized finance that arm you with the tools that you need to make the decisions for yourself on what to do with your portfolio. There are lots of reasons why the market is down, but we're going to highlight arguably sort of the biggest reason on why everything is going the way it's going. Historically, the market loves certainty. Coronavirus throws a wrench into this whole equation by introducing very high levels of uncertainty. Everything involving how quickly it's spreading, no known vaccine. What we'll start off with first is the why. Now, there are plenty of reasons that the stock market is going down, but we're going to be focusing on sort of the biggest overarching, in our opinion, driver on why the market is going down and how we can sort of work with it for our future goals. Historically, the market loves certainty. That means if there's information available at any given point in time for the stock market's already taken that news, digested it, and the prices that you see are reflected with that information in hand. Now, what coronavirus does is throw a wrench into the whole equation because it introduces high levels of risk and uncertainty that normal people don't stomach too well. This, in turn, triggers a global sell-off across the markets because people don't know how long it's going to last, what it's going to do to both businesses, big and small, how supply chains are going to be affected, and what this means for the broader economy later down the line. It is a huge trigger for selling stocks because there's a notion that if you sell your stocks, you can move that money into safer investments, right? This will hold and retain the value of your money more, and the notion is better be safe than sorry. We've all heard that saying. When the market receives good news, however, we do see some upticks up. There are a few days where the market's been up 1 to 3 to even 5%, bouncing back from a global sell-off. But because of the scale of this thing, we're seeing more down than we are up. And that's the part that is worrisome the most. We realize, again, that there are way too many factors at play, right? There's too many things going on in the world that are factoring into the global stock market. But coronavirus is the looming, an overarching issue that's causing for the price fluctuation we've seen, at least in our opinion. Here at Edible Finance, we don't have a particularly new or novel way of approaching this market, but we follow the old saying, sell when others are greedy and buy when others are fearful. We are taking all of these market dips as opportunities to buy into a lot of stocks, both at the individual company level and at the broader index level. Whoa, slow down there, cowboy. What did that mean? That means we are either personally investing into individual companies such as Apple and Microsoft, who we feel that, can weather this sort of virus or this sort of epidemic, and prices are beaten up far more than they should be, or the overarching broader indexes that are made up of multiple companies. Let's take example for the S&P 500, which you may have heard a lot in the news. The S&P 500 is comprised of 500 large American companies all together in one index. We'll explain that in way more detail on a later lesson. This dip in the market could very well continue until the coronavirus situation is sorted out. But if you do have extra cash lying around, this is a fantastic opportunity for you to get into stocks, equities, and all of those things that have been beaten up because of the constant bombardment of this virus. We recommend that you spare some money on a regular cadence so that you're not hit with these ebbs and flows, either weekly, bi-weekly, if you're still getting a paycheck, monthly, however you prefer. You can start with as little as $50, $100, or more if you choose, but the key is to keep depositing into those accounts, and then when you have enough money, to buy into a stock or an index fund. If you have no idea where to begin, index ETFs are usually the best bet to start because they put you, as I mentioned before, in a broad array of companies. You're invested in multiple companies over multiple sectors, which gives you the leg up instead of trying to choose individual stocks that you think might do well or not do well. We would suggest something called a Vanguard ETF. We are no way paid for this suggestion, but we found that this type of ETF is much cheaper because it is professionally managed. They're much cheaper on the investment advisor side of things and very easy to get into during regular market hours. As I mentioned, these Vanguard ETFs have very low built-in management fees so that you get to keep more of your money in your pocket and in your investment. This is just an example of an investment vehicle that you can use while we see these dips in the market. These ETFs typically follow different types of markets, and again, we definitely will go into that on a later lesson. This is just supposed to be hey, this is something to think about during this global sell-off. There's no need to be fearful, but it's best to be practical and to plan for your long-term investment. We suggest using these dips to your advantage. Start depositing money at regular intervals, invest into low-cost ETFs, and reap the benefits when the market starts to turn around after we all get through this. Till then, stay safe, practice social distancing, and keep investing.